Are you tired of living paycheck to paycheck and struggling to make ends meet? Do you want to learn how to invest your money and grow your wealth over time? Many people struggle with finances and are unsure of how to achieve their financial goals. They may be intimidated by the idea of investing and may not know where to start. In this video, we'll discuss the basics of investing and offer some tips on how to get started. By the end of this video, you'll have a better understanding of how to invest your money and achieve your financial goals. So let's get started. Investing your money can be a great way to achieve financial freedom and grow your wealth over time. By understanding the basics of investing, setting your investment goals, diversifying your investments, finding the right investments, and managing your investments, you can increase your chances of success. The first step in investing is to understand the basics. Investing involves putting your money into an asset that has the potential to increase in value over time. There are many different types of assets that you can invest in, including stocks, bonds, real estate, and more. Stocks are shares of ownership in a company. When you invest in stocks, you are essentially buying a small piece of the company. The value of your investment will depend on how well the company performs. If the company does well, the value of your investment will increase. If the company does poorly, the value of your investment will decrease. Bonds are loans that you make to a company or government. When you invest in bonds, you are essentially lending money to the borrower. The borrower agrees to pay you back with interest over time. The value of your investment will depend on the interest rate and how well the borrower performs. Real estate is another popular type of investment. When you invest in real estate, you are buying property with the hope that it will increase in value over time. You can make money from real estate by renting it out, flipping it, or selling it for a profit. Before you start investing, it's important to set your investment goals. What do you hope to achieve by investing? Do you want to save for retirement, pay for your children's education, or simply grow your wealth? When setting your investment goals, it's important to be specific and realistic. Rather than simply saying, I want to make money, consider how much money you want to make and by when. This will help you set a clear target and develop a plan to achieve it. Another important factor to consider when setting your investment goals is your time horizon. If you're investing for retirement, you may have a longer time horizon and can afford to take on more risk. On the other hand, if you're investing for a short-term goal such as saving for a down payment on a house, you may want to take on less risk and prioritize capital preservation. Once you have your investment goals in mind, you can start to think about your investment strategy. This includes determining how much money you have to invest and how much risk you're willing to take. Your risk tolerance will depend on a variety of factors, including your age, financial situation, and investment goals. For example, let's say you're 25 years old and have just started your first full-time job. You want to start investing for your retirement, which is still several decades away. Your investment goal is to grow your wealth over the long term so you can retire comfortably. Based on your age and investment goal, you may be able to take on more risk in your investment strategy. If you're new to investing, it's generally recommended to start with a more conservative investment strategy and gradually increase your exposure to riskier investments over time as you become more comfortable with investing. This can help you avoid significant losses in the early stages of your investment journey. It's also important to consider your investment time horizon when developing your investment strategy. If you have a longer time horizon, you may be able to invest in more volatile assets such as stocks and real estate, which have historically provided higher returns over the long term. However, if you have a shorter time horizon, you may want to focus on more conservative investments such as bonds and cash. One of the most important principles of investing is diversification. Diversification means spreading your money across different types of investments. Diversification is crucial for any investment portfolio. One of the most important ways to diversify your portfolio is to invest across different asset classes, such as stocks, bonds, real estate, and commodities. Each asset class has unique risks and returns, and by investing across a variety of asset classes, you can reduce your overall risk. Additionally, it's important to invest in companies from different industries to further diversify your portfolio. For example, investing only in technology stocks can be risky, as a downturn in the technology industry could cause significant losses. By investing in other industries, such as healthcare, energy, and consumer goods, you can reduce your overall risk. Investing in companies from different geographical regions is also important to reduce your exposure to political, economic, and social risks in any one region. Finally, diversifying across different investment vehicles such as stocks, bonds, mutual funds, and exchange-traded funds, ETFs, is essential for reducing overall risk. Let's say you have $100,000 to invest. Instead of putting all of your money into one stock, you decide to diversify your portfolio across different asset classes. You invest $40,000 in stocks, $30,000 in bonds, $20,000 in real estate investment trusts, REITs, and $10,000 in commodities. Within the stock portion of your portfolio, you also diversify across different industries, investing in technology, healthcare, energy, and consumer goods companies. You also invest in companies from different geographical regions, including the United States, Europe, and Asia. By investing in a variety of investment vehicles, you can take advantage of different market opportunities and reduce the impact of market fluctuations on your portfolio. Finding the right investments can be a daunting task, especially for beginners. Investing in mutual funds or exchange-traded funds, ETFs can be a good approach as they offer exposure to a variety of different investments managed by professionals. These funds provide an easy way to diversify your portfolio across multiple companies, industries, and even countries. Moreover, mutual funds and ETFs come with low fees, which is beneficial in the long run. However, if you prefer to pick individual stocks or bonds, you can do your own research and analysis to make informed investment decisions. You can start by researching different industries and companies, and then narrow down your options based on their financial performance, growth potential, and other factors. It's important to analyze the company's financial statements, including its revenue, earnings, and debt levels, as well as its management team and competitive landscape. It's also important to consider the company's future prospects, such as its growth potential, industry trends, and macroeconomic factors that could impact its performance. Another factor to consider when finding the right investments is your risk tolerance. Some investments are riskier than others, but they also offer higher potential returns. It's important to strike a balance between risk and reward based on your investment goals and timeline. Suppose you have $20,000 to invest in the technology sector and want to research potential companies. After analyzing Apple and Alphabet's financial statements, management teams, and future prospects, you decide to invest $10,000 in each. Apple's strong brand and expansion into new markets, coupled with Alphabet's dominance in the search engine market and investment in AI and cloud computing, make them a good fit for your investment goals. Ultimately, it's important to make informed investment decisions based on research and risk tolerance. Once you've made your investments, it's important to monitor them regularly. This means checking the performance of your investments and making adjustments as needed. For example, if one of your investments is underperforming, you may want to consider selling it and investing in something else. On the other hand, if one of your investments is doing well, you may want to consider investing more money in it. It's also important to keep an eye on your investment fees. Fees can eat into your returns over time, so it's important to choose investments with low fees. You should also be aware of any taxes that you may owe on your investments. Finally, it's important to remember that investing is a long-term game. It's not a get-rich-quick scheme. You may experience some ups and downs along the way, but if you stick to your investment plan and stay disciplined, you can achieve your investment goals over time. Investing your money can be a great way to grow your wealth over time. By understanding the basics of investing, setting your investment goals, diversifying your investments, finding the right investments, and managing your investments, you can increase your chances of success. Remember, investing is a long-term game. It's important to stay disciplined and stick to your investment plan even during times of market volatility. By doing so, you can achieve your investment goals and secure your financial future. We hope you found this video helpful and informative. If you have any questions or comments, please feel free to leave them in the comments section below. And don't forget to subscribe to our channel for more financial education and investment tips.